Welcome back to Financial Frontier. I'm your host, Patrick Camuso. I'm joined again today by a returning guest, Miles Fuller, the Senior Director of Government Solutions at TaxBit. And he's returning to the show after our last episode we did in the fall, where we were discussing Form 1099-DA and the broker reporting framework and some of our expectations surrounding that. So here we are, the first initial filing season passed, now behind us as we're approaching the extension deadline. And we're getting into today's episode, what did this actually look like? Where is IRS enforcement potentially heading when this data starts flowing into their systems? What are some of the legislative outlook around some of the bills related to digital asset taxation, as well as the international reporting framework that's going to be phrasing it in behind this. So we're going to cover a lot of ground today. Miles, thanks for joining us on the episode here. Glad to have you back on.
No, thank you. Thanks for having me back. Happy to jump into some of these issues. Yeah, it's our first filing season with 1099 DAs, at least, partially completed 1099 DAs coming in year one. So yeah, happy to jump into it and talk about some stuff.
Absolutely. And I want to start right there. So year one of 1099 DA reporting. From your seat at TaxBit, what have been some of the biggest challenges for brokers? And has there been any, unforeseen issues that you've encountered dealing with this first site?
Yeah, I think from the tax perspective, there's a slight shameless plug. I don't think as TaxBit, for our customers, we didn't stumble into a lot of issues. I think we had a really successful tax season. However, with respect to, as you probably understand, enabling that filing process with the IRS, like the submission, the IRS had a validation issue where they were rejecting certain forms that the values of proceeds were zero. And because they were being rounded. So imagine a small, tiny fractional amount so you had like less than a cent, the form would round to zero. That's the way the form's designed. The IRS was rejecting those forms. Obviously, that's not legally correct. You should be filing the form because you can imagine next year when there's cost basis, even if your proceeds rounds to zero, but your cost basis is $10 or something, you want the IRS to have that information to make sure they do it right. So we were able to point it out to the IRS and give them a heads up. And I think they were able to get that fixed. So that was sort of really our only issue. Was that. But there are, I know practitioners that had issues, particularly, so we can get into some of those if you like, of things I heard from the preparer side.
Yeah, what was your perspective on that? Were you receiving any feedback from that? Did you see brokers receive any feedback from that? What's your perspective there?
Yeah, from the biggest issue hurdle I talked to a lot of practitioners about that they came back with was really probably two areas. One was forms being received from certain brokers that had issues, either delinquency in the timing. They came in way later than expected, and some people had already kind of filed. And the other one is at least for a few people from one of the brokers, and I'm not here to name names, but they received duplicate forms. So one particular client, if somebody was a pretty massive crypto whale kind of, received duplicate forms of every 1099. So they were very concerned that the IRS is getting duplicate proceeds. And that was a big kerfuffle. So that's on the broker side. The next step was just within them, the stablecoin issue, the aggregation of stablecoins, the fact that some stablecoin stuff isn't being reported on. That caused a huge reconciliation problem, even just from proceeds, where I think it caused difficulties for preparers as well as customer-client confusion because they kind of were like, oh, if we're not getting 1099 for these stablecoins, do we not have to report them? So that was a hurdle, I think, probably with a lot of people in the preparer community.
Yeah, I've seen the same thing on my side at Camuso CPA. In terms of the late 1099 DAs, that was something that I was worried about and actually have been flagging on the Financial Frontier. So, we positioned our clients where we placed them on an extension just in case that happened. But, it caused a lot of problems for taxpayers, obviously. The stablecoin issue, again, kind of like you guys at TaxBit, we were anticipating that, so we're able to deal with those reconciliation issues, but definitely had to field questions from clients on that, regarding the mechanics of that and why certain transactions maybe aren't being reported on the 1099 DA.
Mm-hmm.
So yeah, those two areas are confusing. And these sort of reconciliation questions now are going to be carrying through here as we go into this next tax reporting year for 2026, which brings me to my next point. We have notice 2026-20 that's extending the transitional relief that was originally provided by Notice 2025-7, which in a nutshell allows taxpayers to use their own books and records to identify which tax lots are being sold, rather than defaulting to whatever their broker's ordering rules are that they set with them. The IRS acknowledged that this broker reported acquisition dates and basis is not going to necessarily now match up to what the broker's going to be reporting next year. And, we're seeing a lot of commentary from practitioners that, this is going to create almost an ongoing or like persistent mismatch now that's like structurally built into the regime for any taxpayers that have this divergence between the accounting methodologies this year. What's your take on that? Do you think that this is going to be an issue for taxpayers that are, they're not going to default to FIFO this year? They're going to order their books and records possibly different from their broker, and then they're going to have this persistent mismatch going forward. What's your thoughts on?
Yeah, I mean, I think you've touched on a big point. Obviously, the easiest answer as a taxpayer, not ideal, would be to, if that is your situation where your broker is not able to take that lot identification information during the year, to just default to FIFO yourself as a taxpayer, knowing that's what your broker is going to do. Obviously not ideal. Here at TaxBit, our platform has the ability to handle that. What we've been talking about internally, and I think the approach, to the extent we have clients, enterprise broker clients that are willing to go for it, is really, if you assume throughout the year the individual customer is maintaining their own personal records, what you'd like to see is maybe as of the end of the year, so like as of 12/31, a UI-based interface with the broker that allows that person to go and input all of their personal records from throughout the year into the broker's information to kind of override that default to FIFO, assuming by the end of the year the broker's up and running and has the ability to accept that information kind of as a one. You're always supposed to identify lots at the time of the sale. Here we'd be accepting that the client did it at the time of the sale and just giving them the opportunity to update it at the end of the year. So we're looking to enable that capability. It obviously requires some technological lift on the broker side to give that, but that would really be the clearest path to allow this sort of disconnect to not happen. If the brokers can get the personal records before they actually file the to make the update from the FIFO default. That's what we're trying to enable here.
Yeah, so this is going to be a big challenge, and I agree. When I'm speaking to most taxpayers, I tell them the simplest approach is to default to FIFO, and it can lead to less control over the timing of tax events. But also when you consider Revenue Procedure 2024-28, your wallets and accounts are separating your tax lots, and you're very on top of with your flow of funds from those wallets. You can still have some of that controlling over that tax event timing without applying Spec ID and be in a stronger position for compliance. So that's been one thing that I've been looking at with clients and working with some of them on to where we're optimizing compliance and still maybe getting some of that tax flexibility. But the bigger thing here is that brokers are they still have substantial infrastructure to build out that's under an evolving framework when it comes to accepting this client data or customer data, I should say, as well as the sharing of data between other brokers. So can you walk us through at a high level, the scope of that undertaking for brokers and where are they at?
Yeah, I mean, I think they're still working through it. I mean, by and large, I think most brokers are in the process. I mean, again, coming from a company like TaxBit that enables this type of filing, I like to say, TaxBit has a platform that is actually all built out and very robust. Obviously, the platform itself, there's a connectivity issue as brokers have to align, there's some internal infrastructure to connect and integrate with our platform, but it's all kind of there. That main primary infrastructure all exists within our platform. I do think in your comment, you noted something interesting about the sharing of information with other brokers. And maybe later, I know you'd mentioned maybe touching on a little bit of some of the legislation and other stuff going on. This is, to me, one of the biggest favors the government could do, and it's not even really a legislative one. It's really at the Treasury Department, is get the regulations issued under 6045 Cap A that relate to broker-to-broker transfer statements, because that's going to be the next biggest step to decrease chaos.
Yes.
For people that you might have, you probably have a lot of clients that are sort of very heavy crypto, like non-custodial people. But for the portion of the ecosystem that are people either trading just on one custodial exchange or maybe one or two custodial exchanges. People with one or two custodial exchanges, their world gets super simple if we implement those regulations for transfer statements. So just do it. You can make it look a lot like, the transfer statements we do for traditional finance, and it just get brokers on the path so they can start building that and get it working.
Yeah, I agree with you there. And there is this sort of separation now between these different types of market participants, right? And like really who the 1099 is helping now is just if you're on one exchange, but it can get that next cohort of more like simple users to where maybe they're on 2 or 3 exchanges, and it can all be held within this form if they're able to implement that. Where it does get more difficult and there's going to be these persistent challenges is for a lot of the clients we do have that have these legacy assets that they've held for a long time, and or are transacting in these DeFi and non-custodial environments. So one element of this, when we're even dealing with clients that are on multiple exchanges as well as across wallets, of course, is there's no consistency or set format for all of the data, and that's true for brokers as well. And I'm sure it's something that you guys have to deal with at TaxBit. And I believe, this is probably a big value add that you're offering to brokers, is normalizing a lot of this data in addition to categorizing it. So, this is something we deal with as practitioners, and it's something that brokers deal with. So how much of those issues with that fragmentation in the data format is playing into like this difficulty with establishing all of these systems when it comes to transfer records, when it comes to all the cost basis data? Does that play into this or
no? It totally does. I mean, the helpful point here is, at least when you're looking at custodial brokers who are subject to information reporting, you have the 1099 schema. Here's what you need to have is like a data model. One of the first things we did years ago at TaxBit for our broker clients was sort of build out what I would call like data ingestion harmonization stuff to make that process very easy. And it is one of the biggest lists, where as we onboard new customers in the broker space, is helping them get the data cleaned up to a good data model. So on the broker side, I think that problem's slowly getting resolved. But I do agree with you, like when you move outside the broker, or when you are just an individual taxpayer wanting to go access the information from your broker, not from a 1099 but just your own transaction history, most of the brokers are still like the API syncs or the downloaded CSVs are not, they aren't tax oriented. They're just like transactional oriented. And so I think that's the next biggest lift for brokers, is to start rethinking like, hey, I should kind of create a tax download sync in the way we would see it. Like I could go to Charles Schwab or someone and sync that to my personal financial software or to TurboTax and just pull down effectively all the 1099 tax relevant information without having to look at a 1099B. So that's, I think, the next step for brokers. We have APIs here that are effectively that's how our system operates, but they aren't always enabled or used by brokers on our customer side. And we've had conversations about how can we help them use those better for their clients.
So then, switching more onto the DeFi side, because this actually plays into somewhat of what I'm seeing with taxpayers and practitioners with the broker reporting. Because obviously DeFi sits outside of the broker reporting regime as a result of the Congressional Review Act revocation, which I believe, Miles, we discussed on our first episode. And I've discussed that length on the financial frontier overall. So there's this structural gap. And what I'm starting to see is open dialogues where practitioners and taxpayers are starting to discuss strategies of keeping, the majority of their transactions in DeFi in non-custodial environments, and really, saving their interactions with brokers for on-ramping and off-ramping with stablecoins. So, this is going to be interesting to see if this behavioral pattern actually does develop. I'd be interested to hear from your vantage point, you're seeing any data that may lend to that. But more deeply than that is, what's your overall perspective on this? Obviously, that type of behavior could simplify reporting to a certain degree for taxpayers, but also, this 1099 DA is being implemented to resolve an, non-compliance and under-reporting problem that, this could actually start to move into that territory a bit as well, depending on how taxpayers report overall. So have you seen this at all, and what's your perspective?
Yeah, I've heard this thought bubble up. I have not yet to clearly see it in practice. But again, given the behavior pattern, you might not actually see it because people are kind of under the radar.
Yeah.
It could be a possibility to, over time, that we really start to see it materialize. It certainly could only lend to that, what you were describing earlier, is like the third category of taxpayers who are like doing non-custodial stuff. The custodial people, it's not going to impact. My thinking is, it gives me curiosity as we go forward. Obviously, here domestically in the US, we had DeFi broker regs that were quickly overturned, invalidated, under the Congressional Review Act. However, you got to be cautious on the international front. With CARF, other jurisdictions, there are working, I think, even now on trying to revise the FATF. One of the parts of OECD has what they call the cozy sort of, I forget the thing, like basically the amount of control or influence. And they're working on trying to refine that. So you might see that come in through CARF, where you're going to start to see DeFi coverage, which the United States is expected to adopt CARF. So I wouldn't be surprised if at some future state we revisit this DeFi question. People will not be happy with that. It's a big sort of lightning rod point, I think, from a culture and a political and a policy level. But it might be, if the what you're describing comes to fruition, then there might really be some need to rethink it if we see people actually doing that activity.
Yeah. And, there's going to be the potential for this to manifest. And if there's persistent noncompliance, of course, there's going to be a response to that, like you're alluding to. But then also, one of the points I've been raising is as the industry starts to, they're coming under this whole new compliance regime, and they start to feel all the friction from it. That's really just starting. They may say, why is this so difficult? Why can't we have tax reporting in DeFi to simplify things? But like you said, there's the whole mindset that's at the very foundations of the industry, where privacy is deeply valued. And, a lot of people have objections to tying their identities to wallets and having all of this exist at that level. So it's interesting to see where this goes. Like you said, the US does not exist in a vacuum due to things like CARF. So, we're going to have to see how this develops here. So, underreporting, right? Like that is what we're trying to solve with the 1099 DA. And it is something that everyone's discussing and everyone's kind of got their take on it. I've asked many guests this on the financial frontier. I think I've even asked you it in the past, in terms of like, we have this data that's flowing in now. We have the tax returns that the IRS is getting from taxpayers. They're able to compare this information. What is enforcement going to look like? And when are we going to start to see this really pick up? Some people, and like I said, the industry and even guests in the show are split. Like some people are saying you're going to see it very quickly this year. Others are expecting a slower ramp up, that this may happen over several years. What's your opinion on this now as we're through this first filing?
Yeah, I have thoughts. I was almost going to go back to try to rewatch our prior conversation, I think, on this point, but it doesn't really matter. I may give you my thoughts off the cuff today. My first sort of premise is a lack of, I feel like even within the IRS, in my time there, and then having worked with the IRS from the TaxBit side here at times on examinations, there's not really crypto exceptionalism. And what I mean is they're not like they'll say it's an enforcement area, but they're not going to ramp up like, what you're thinking of here is they're getting all these forms, or they're going to like turn on the automated underreporter systems or whatever, like over just totally at crypto. I don't see that happening. Like it'll just be part of their normal flow. The other thing, so I wouldn't be so worried about crypto more than anything else. The other thing is clearly, for the broker side, there's penalty relief that they told from a reporting like inaccuracy standpoint. So the IRS knows there's going to be errors with forms. If you take that premise, that also means that the errors with forms might lead to inappropriate audits. So they're probably not going to charge very hard in this first year at people. I do think when we think about AUR and that stuff, is what they will be looking for. And the way those systems work is they don't do transaction level like reconciliations at the, they're doing aggregate like proceeds and then the nets that roll up almost onto Schedule D with not just crypto, but other stuff. So I would envision a system where and obviously this year they can't do the net because there's no cost basis. So they know that would be wrong. So they're just going to look for proceeds. And really what it's probably going to look like is they're going to look for people that should have proceeds that maybe didn't report. So very low hanging fruit people, and they will chase those people. So if you're reporting and you're basically reporting proceeds that are consistent with your DAs, you're probably in a safe space, at least for the next year or two, because that's all the further I'm guessing the IRS will go. We also know that they're living under this umbrella of they had a ton of people leave, a lot of their knowledge base around crypto left. So I'm not even sure who they would have to do the audits if they went after people. So there's a question there.
Yeah. And, that brings me to my next point. What you said is really interesting, that, it's more pragmatic, right? If they go after everyone that has, they'll are misreported on their proceeds, they're not going to have the resources to even deal with the level tax notices that may come out regarding that. But, some practitioners are saying you need to match your proceeds exactly. If you don't, you're going to get a matching notice. You're going to have all of these issues. But you're kind of raising the point that we're not going to see low materiality thresholds with AUR, for instance. And you think that they're just probably going to focus on proceeds. And then, like, what about future years? Is this going to get down to like these small materiality thresholds, do you think, to where you do want to be like perfectly aligned? Or if, the broker's reporting, X proceeds and we're reporting Y and there's 1% materiality difference, are we going to start to see notices on something like that? Or is that just not practical from a tax administration standpoint?
My hunch would be the latter, like that it's not practical. And this goes back to my point. Like, I don't see a path where there's sort of crypto exceptionalism from the IRS perspective, meaning they're not going to single out, at least in that AUR like flow when they're doing the matching. They have variance thresholds. I think sure everyone's aware when they do it for 1099Bs or anything else. They will use probably similar variance thresholds. I could see where they might, they will be tuning them in their internal infrastructure machine to say, hey, and maybe even in crypto, I could see a world where those thresholds are a little bit widened because they know that the crypto data is a little messier. So if you had a 1% tolerance level, maybe they make it 3% on crypto. I've seen that over the years. It's kind of like a spigot. It's like, how tight do they want to make it, and it all goes to what's their resources to enforce within reason.
Because obviously there's a lot more variables when it comes to crypto reporting, and there is two sets of reporting getting reconciled together. So it would stand to reason that there should be somewhat of a higher materiality threshold than just someone recording straight off of their 1099B, but it is yet to be seen. So that should be interesting. And then you bring up the other point as well from this whole perspective is the capacity constraint at the IRS, which I believe we touched on a bit in our prior episode as well. What is a realistic outlook overall regarding digital asset enforcement capacity? And let's say like over the next maybe like 2 to 3 years, how does this play out between just matching and correspondence handling versus selecting people for exams? Is it going to be just really looking for, the low-hanging fruit non-recorders that this whole form is designed for, like you kind of alluded to, or what's your perspective?
Yeah, it's a big question mark is really what it is. I know people within the agency and people that have left and people that are still there. They've lost a lot of talent, a lot of their enforcement people, some of them the best people with crypto related knowledge. So there's a question mark is like, how much enforcement are they really going to be able to do? Or do they try and do it and they just do it poorly? The flip side is I've heard from the higher echelons. I was at a bar conference speaking at the beginning of the year. Jared Koopman, who was still as the acting CTCO, was speaking that like, yeah, digital assets, still a compliance campaign. Like we're still doing this stuff. So they kind of say like everything's good and they have it all taken care of as like the top level messaging from the IRS. But then when you get underneath the hood a little bit, it's less clear like what's going to happen. And what they're going to do with stuff. And it's a big question mark. What makes it worse is you may get audited and it may be a terrible experience because the person you're dealing with really lacks any knowledge about crypto or the data or anything to facilitate the audit in a meaningful way for the taxpayer.
Yeah, and that can be very challenging. And, it's going to be on the taxpayer to substantiate every cost basis, every proceeds that they claim. And, that's when it comes down to having very good accounting records. So switching gears a bit, there's another factor that's playing into how this whole compliance environment is going to really shape this industry, and that's the legislative piece. We have, clarity that was passed last week on the market structure side, and we're seeing on the tax side, we have Lummis, PARITY, Senate finance package, all in motion. From your perspective across all these bills, where do you see, the most consensus on certain provisions, and where do you see the most meaningful disagreement, or like what is sort of top of mind from you out of all of these potential tax changes?
Yeah, there's probably quite a bit to unpack on that. I'll give you one or two hot takes. The first one that I see that actually I like maybe coming to fruition, if we go all the way back to Genius Act passed last year, obviously they're doing implementing regulations. You and I talked just a short bit ago about the stablecoin disconnect with reporting, better alignment there, which I think is what we're seeing in the draft from the House side on the PARITY Act. That's like really the digital tax related bill with stuff, trying to align the definition we have in the 1099 DA regs for qualified stablecoin, aligning it more to the Genius Act, just to make a clean thing. I think that's the first thing they could clean up. Otherwise, we look at clarity as sort of market structure style. I think as practitioners and tax rules, got to be paying attention to how classifications of assets coming out of those bills passage might impact downstream tax treatment. All of a sudden you might have digital asset commodities as a thing that's in clarity. Like, does that all of a sudden mean this crypto stuff for tax purposes? Certain ones that meet that definition are now going to be commodities for tax, which changes the treatment. Maybe you get 475 election out of it if you want to mark to market, those kind of things. So that's what's really to pay attention to. My last comment I'll give is the hottest point, it seems to be with the crypto specific ones. This is the Max Miller Horsford bill coming out of the House side, at least, that does de minimis. And it's like, what should be the scope of de minimis? Stable coins, or then you have the Lummis bill on the Senate side. Should it be everything? And that's an interesting debate that, we could probably spend all day talking about.
Yeah, and I actually do want to get into the de minimis debate because it is a hot topic. And, there's I guess two camps, right? Apply it just to stable coins, apply it to all digital assets. They want ease of transactions with digital assets on one side. On the other side, they would argue that providing a de minimis to digital assets broadly would not be in line with how the tax code is usually administered, and applying it just to stable coins would be more analogous to foreign currencies. So I'd like to hear your take on that, as well as, is the de minimis going to really, if we do see it, and, I want to hear your perspective on, do you want to see it? And if we do see it, how does it practically look? Are taxpayers going to still be tracking these transactions to see if it's within the range of a de minimis and tracking it for cost basis purposes? And does that undermine somewhat of the purpose of it to begin with?
Yeah, I think you touched on one of the things that's always bothered me. I find this question interesting. I taught an LLM class at a local law school here, and my final exam question to my students, it was crypto tax practice, like policy and practice. My final exam had this specific question on it, like as a policy question of like, go look at these possible provisions, the Senate side, the House side, or like the nothing, should there be nothing? And like, you'll walk through the types of things you're raising. Assuming the Senate side got passed and the House side got passed, both as is, they'd obviously go to reconciliation and there'd be a big debate on, should it be everything? Should it be stablecoin? My take is the everything approach. So all crypto. That provision has been kicked around since like 2017, and it's just never really gotten traction. So there's a political element here of like, what's palatable to the members of Congress to actually pass. It seems like the all crypto approach may not really be palatable. So that's why it's never gone anywhere. I think in the House side bill, they've done the right thing by trying to slim it down to make it more palatable so they can actually get something passed. So that might make sense to do it. The adoption idea, the policy mechanism behind it's great. Like, you're trying to promote adoption, whatever. I think that brings me in my thinking, though, to the question you raised is like, will people really I'm sure they will take advantage of it if it passes, but I don't know that it changes the game in terms of the record keeping you have to do. As a practitioner, you prepare a tax return. If I need to exclaim an exclusion or an exemption or something for part of something, I need to have all the records to do the analysis, and then I just get to carve out a little piece. So, I don't know. And then when we're only doing it on stablecoins, you're not really saving any money because stablecoins probably have almost no gain or loss on them anyway. So I don't know if the policy purpose will carry through, but we'll see. It's an interesting issue.
And you're right. When it's just with the stablecoins, it's pretty much tax neutral. To a large degree, right? And then you still have the tracking requirement. So it's interesting, like the concept of it, creating, it easier to transact in crypto. But the record keeping issue is something that I'm gonna be very interested in to see if and how it's addressed if this does get implemented. So, another or two other, I would say, hot topics, both of which that have, like the been discussed for many is wash sales applying the crypto and staking recognition, getting a deferral on recognition. These are interesting because, they would produce different winners and losers across the industry, right? Like, stakers and miners are going to benefit from the deferral. They'll get the tax optionality. They'll have simpler year-end record keeping, where, active investors are going to face the tracking complexity associated with wash sales, as well as having this tax exposure in a 61-day window. So what is your perspective on that? And how do you see these dynamics playing out? Because from my perspective, wash sales seems to be the biggest portion of any of these tax changes that actually, is going to put money back into the treasury versus a lot of like something like staking where you're going to get a deferral. So, there's a lot of people that are in mixed camps on this, and there's, we can get into all the staking discussions and this from a technical perspective and a policy perspective, I think both factor in here. So what's your overall thoughts on it?
Yeah, I mean, starting with wash sale, you're spot on. Wash sale's been talked about for a long time as very like low-hanging fruit. Any legislation Congress tries to do, they like to keep it quote unquote revenue neutral. Wash sale would be a raiser. It'd bring more money in, at least on paper. That's what it seems would happen. So it seems like an easy thing to do to pass to offset other like sort of basically giveaways under legislation where they're going to reduce revenue. Generally, it seems to align. Like wash sale makes sense. We want to treat crypto like securities. That makes sense. I have heard a few practitioners embrace some good points though around these make sense. Like, well, what about the person who uses some, you go back to the de minimis thing, and I'm using for personal expenditures crypto, but then I buy another Bitcoin to replace. Like, if there's some not overly, like you could run these people all of a sudden get stuck in the wash sale rule for all these other personal transactions, whether or not de minimis exists. But it creates a bigger reporting complexity because of the mixed, I think it is tax people, we talk about mixed character used. It's not just the crypto for investment where wash sale would be fine. That's straightforward. You have mixed use, like payments for stuff or whatever, and how does that play out? So it maybe gives me pause that wash sale is not the best, but I anticipate it would go through. Pivoting to the staking reward stuff, I actually like the Max Miller proposal. This is something over time, everyone has believed that the deferral is the best tax policy or whatever. I don't know when that really came. I remember being on a call after the Lummis bill was introduced last summer with actually some practitioners who were like, is there a way they can maybe do an election? Because I have clients who would actually rather take it as income today and then make it be a capital asset because they're going to hold it longer for long term, and then they can take a better rate on the appreciation. I like that the Max Miller bill does that. It introduces that optionality for taxpayers to be able to do it either way. I think they have a little bit of cleaning up to do on the complexity with how to implement that. Like, the 5-year thing, they kind of, I know Max Miller's at least side, they kind of looked at Section 83 for like how to mimic that a little bit, like for vesting schedules. So there's a little bit mess there, but I like the approach from a policy to give taxpayers the ability to, hey, I want to do it this way or that way, and then I just need a record keep.
Yeah. From the staking side, you see the perspective where it's not just a technical tax question; it's a matter of policy, and are you going to have staking validators located in the U.S. or located elsewhere? So I think both of those sides get considered in all this as well. And I agree. I like the election because it gives more flexibility to taxpayers to work with their CPA, and they have a compliant path to either direction, and they can optimize that from a tax perspective, clearly, legally, and compliantly. So we touched on this a bit earlier, but we're not just looking at this broker reporting regime in the US that's phasing in. We have CARF and DAC8 reporting that started, and first reporting is going to start to phase in next year. These regimes require, in certain circumstances, a bit more information than a 1099 DA on the customer regarding like their tax residency and other things. So, the brokers that you're working with, they're still building out the 1099 D, dealing with the challenges that we discussed from that perspective with cost basis, collecting from the customer, transferring it to other exchanges. Now, on top of that, they're going to be building for these international obligations as well. So how are brokers dealing with that? Because these do have a lot of overlap, but they are separate reporting systems. So, how are brokers dealing with that and kind of like sequencing all these compliance challenges that exist?
This is where my somewhat knee-jerk or shameless plug for TaxBit would be like, we're telling people come to TaxBit. We handle all of these. We handle domestic DA reporting, but also CARF, the various CARF regimes. But you're right. The regimes, the U.S. has not yet formally said it's adopting CARF, but that's the word on the street. But other jurisdictions have CARF. If you think of it as two steps, in the U.S., we have tax KYC, onboarding, TIN matching, all that stuff, W8, W9. That's what the brokers have been working on as part of the DA regime in general. You move over to CARF, you have basically self-certification, which is all the stuff you mentioned, like residency, all of that stuff, all designed to facilitate what is known as like automated exchange of information among jurisdictions. So you can get information shared among various jurisdictions internationally. Brokers, I think, they're fighting this battle on two fronts. They were trying to get stuff up and running here in the US. They are now going to be getting stuff up and running in other jurisdictions, as you mentioned, CARF jurisdictions. And I will, for people that are curious about this, TaxBit at its website, so taxbit.com, we actually have a CARF reg tracker. So it actually goes jurisdiction by jurisdiction where they're at and when they're implementing. There is anecdotally what we refer to as wave 1 jurisdictions, which will be kicking off CARF next year, 2027, and then wave 2, which is 2028, wave 3, and so on. So you can always go there for the latest details if you're in the broker space and trying to figure out what your obligations are. But yeah, it's building two things at once with slightly different requirements, which is a big onus on brokers, and I think has impacted how brokers are here. I know domestically where the conversation with the US had been a little bit about like, hey, are we going to throw out CARF in the US and then like layer a separate regime on top of the DA regime? I think that's kind of what they really should be doing, is trying to layer CARF into the existing DA regime and just open up the thing. Domestically under the DA regime, you're generally only picking up people that are US residents. So brokers could open up the aperture to pick up the non-US residents that are here domestic, because those become your CARF residents where you're gonna have to exchange. So there's a way to do that to minimize the burden, instead of having like two completely separate reporting regimes, which I think from a policy standpoint is not what they should do, but I'm not sure what Treasury's got going on in that sense. But yeah, it's a big lift for brokers.
And then, we touched on this a bit earlier as well, but the US is planning to adopt this. And, they're going to have to comply with this. And how is that going to shape compliance and data collection here in the US over, say, like the next 5 years? And will this spill over into DeFi eventually? Like, is that where you see this all going from that perspective?
Yeah, if we break that into two parts, setting DeFi aside for the first moment, I definitely think it's going to shape compliance. You're going to have an IRS that is getting information, assuming it adopts, sharing that information outbound. That's a new thing for the IRS. Here we have FATCA. Under FATCA, the United States is a taker, not a giver. We don't give information. The rest of the world does CRS. We don't participate in CRS. So CARF would be the first time the U.S. needs to send outbound information on people living in the U.S. that are, foreign people to other jurisdictions. But as a result, the IRS is going to get a tremendous amount of data from these other jurisdictions about U.S. people. That's a huge data lift for the IRS to digest already. And then I think the direction you'll see is, then as OECD and stuff start to implement DeFi side stuff, if the US wants to stay in the game, because they're not, they don't get to stand by themselves here, you will see that trickle into the US, and we may be back to where we talked earlier, revisiting DeFi level kind of regulations.
Yeah, so it's going to be really interesting to see how this plays out, because the US does not exist in a vacuum under regulations like this. So we'll be watching that closely, and I'm sure we'll be back discussing the developments here as this all unfolds. So Miles, this has been a great conversation. Where, from your perspective, where should brokers really be concentrating their efforts right now to be well positioned over the next 12 to 18 months for compliance and reporting? And similarly, from a tax perspective, if you have any from a taxpayer's perspective, if you have any recommendations there as well.
Yeah. So first, taking with the brokers, it's hard to see individually at the broker level where they're all at in their build process. So I'd say just keep trucking along. I do think for brokers, one thing to consider is obviously the problem we talked about earlier under the 2026 notice, the FIFO default problem, trying to think about helping your customers solution for that, so you don't get on this weird path where things are going divergent. And then separate is, being aware of and paying attention to where the CARF stuff is coming in. What are your requirements internationally when you got to onboard? And so that's where I mentioned earlier, you can track, like TaxBit just for tracking information has a good website page for that. So that's on the broker side. And then on the taxpayer side, my recommendations are, as always, like keep good records. This is going to be a mess for another year or two. So be diligent in your record keeping, know where you're at, what you're doing. There may be an opportunity to discuss even mid-year like this with your tax preparer or your planner about, as you mentioned earlier, is it worth next year with a broker who can't take my lot identifications, just defaulting for 1 year to FIFO just to mirror them, even if it kind of sucks, like not the ideal tax thing, but you will not get on this path of like having stuff messed up going forward for however long. So that's my taxpayer side suggestion. And then, otherwise, then we'll just wait and see what the legislation that pans out is and how that might change the rules as well.
Absolutely. Now, that'll be setting all new questions up for taxpayers and, new things to work on when it comes to applying wash sales and staking. So it'll be interesting to see how that develops as well. So Miles, this has been a great conversation. To everyone that's been watching, I hope you took some value from this conversation. If people want to get in contact with you, what's the best place for them to reach out to you, both if they want to speak with TaxBit? I know, like you've mentioned, you guys have a ton of resources on your site. I encourage everyone to check that out. And then also, if they want to get in contact with you personally, what's the best way to contact you?
From TaxBit, obviously go to the website. You can get me personally for TaxBit stuff at Miles Fuller at taxbit.com, or if you're more of a practitioner or have a question or whatever, you can also always catch me on LinkedIn. Just DM me there. And I can get back to you if it's outside sort of that broker realm or stuff like that we do. Happy to chat with people. However, I love talking about this stuff. There's some interesting issues and some changes coming down the pipeline.
Absolutely. And Miles, you bring a very interesting perspective because you have the information reporting perspective as well as the tax litigation perspective. So I encourage practitioners and brokers, anyone that does have questions, reach out to Miles. He is a great resource. So again, Miles, I want to thank you for being a guest. Definitely looking forward to having you back on in the future to where, we can sort of pick up this conversation where we left off. And to everyone listening, I do hope you took some value from this conversation. Until next time, I'm Patrick Camuso.